The stock market bubble already burst, but is there a real estate bubble that's gonna burst too? What's up everybody, I am Jaspreet Singh and welcome to the Minority Mindset. The economy and every asset class goes in cycles. There are times where the economy and assets are going up and there are times where the economy and asset classes are coming down. I'm not making this up, it's actually how it works. Booms and busts are a part of the economy. They have happened in the past and they will continue to happen. I want you to understand this so you can use this information to your advantage instead of getting abused by it. For the last decade or so, after the 2008 Great Recession, the stock market, the real estate market, and the economy went pretty much straight up. This 2020 pandemic poked a needle into the economy, and then all of a sudden the economy tanked, and with it came the stock market. But what does that mean for those of you who own or want to own real estate? I mean, if you remember, after the 2008 crash, real estate was selling for literally pennies on the dollar. Homes that were selling for $100,000 before the crash were selling for $25,000 after the crash. Will that happen again? Well, you're in the right place because we're going to be talking about the real estate market, and you want to make sure you watch this video until the end because I'm going to be talking about whether there's a real estate bubble forming and if this bubble is going to burst or not. But before we can get into that, hit that thumbs up button below because if you don't, then YouTube doesn't share a video with anybody else. Subscribe to the Minority Mindset YouTube channel. That way you don't miss our new financial education videos every single week. And hit that little notification bell too because if you don't, then YouTube doesn't let you know when the new videos are released. When you invest in real estate, you buy property like a house or an apartment complex or an office building, not to live in or use yourself, but to rent out to other people in exchange for monthly rental payments. So you buy a home and then you rent it out to George. George moves in and now George is going to pay you $1,000 a month every month that George lives there. And if you do it correctly, this $1,000 that George is paying you is going to cover all of your monthly expenses. It's going to cover your loan payment if you have one, and it should put some money in your pocket every single month. Let's start with the good. The good is that real estate can be a completely passive source of cash flow once you know what to do. That means you have to go through a learning curve, which requires a good amount of work in the beginning. Once you get the hang of it, all you have to do is find a good property to invest in, and then you can hand over the keys to a property management company who will just take a percentage of your rental income, and in exchange, they will handle all of your day-to-day operations, and they will pretty much be responsible for depositing the checks into your bank account, so you don't really have much day-to-day work. Plus, real estate is a legal tax loophole. Wealthy people love owning real estate because when you own real estate, you for one, own something that you can see, feel, touch, and control, which is not what you get when you invest in the stock market. You get steady passive income, and three, you get huge tax breaks. I can tell you this because, well, I'm an attorney and I am a real estate investor, but that being said, I am not your attorney, so if you have specific legal questions, talk to an attorney in your area. That's the good. The downfall is real estate investing is much more active than investing in stocks. You have to deal with tenants or hire a property management company that will deal with tenants, and it's a lot more expensive to start. But if real estate prices crash, that makes investing in real estate much more accessible. The best way to predict what's coming next isn't by guessing and ranting all your emotions and thoughts on Facebook, like everybody likes to do. It's by looking at history and seeing what history tells us because, well, history tends to repeat itself. We've never seen a pandemic like this before, but we've seen economic and real estate crashes. So let's start by looking at 2008 because that 2008 financial meltdown was caused mainly by the real estate housing collapse. In the early to mid 2000s, banks were handing out mortgages like lollipops. During that time, applying for a mortgage was kind of like what applying for a credit card is now. You didn't need any sort of income verification. All you had to do was go to the bank and write down how much money you made, and the banks wouldn't check that. So you can write down whatever number you wanted to, and based on what number you wrote down, you will get approved for a mortgage based on that number. So if you make $75,000 a year, why not just bump that number up to, I don't know, $110,000 a year? That way you can get approved for a bigger loan, and now you can buy a bigger dream home for your family. Not to mention the fact that banks are selling variable interest loans that had special teaser intro rates, which means you would start off with a very low monthly mortgage payment, and then over time that mortgage payment would go up, but banks didn't really like to tell you that part. Then to make this lending problem even worse, banks created something called ninja loans. NINJA, which stands for no income, no job, no asset loans, which means you could pretty much not have anything and go into a bank and walk out with hundreds of thousands of dollars to buy a home because real estate never goes down in value. Oh, and sometimes they throw in a free TV too. This created a massive real estate bubble because you had all these buyers for homes that couldn't afford their homes, and this inflated the price of real estate. And then to make this problem worse, banks got greedy. Well, I guess they were already greedy. They got greedier. Banks realized that, yeah, they can make money on the lending side by lending you money to buy a home, which they were already doing, even if you couldn't afford to buy a home. But they could also make money on the backside by selling your loan as an investment to another bank. So what banks would do is they would take up a bunch of loans, a couple which were good, most of which were really crappy loans, and they would bundle them together into something called a CDO, or collateralized debt obligation. And so then they would take the CDO, which is a package full of a bunch of loans, most of which were crap, and then they would sell the CDO to another bank. Then banks couldn't believe at how profitable these CDOs were because they were selling these crappy packages of loans to other banks and wealthy institutions and wealthy investors at huge profits. And so they started doing it more and more and more. And so now banks were buying and selling hundreds of billions of dollars worth of these CDOs. So you kind of had the circular problem because banks were selling loans to people who couldn't afford them because they thought real estate could never go down in value, and they made all this money on the loan, and then they would take this loan and then they would sell it to somebody else in a package full of other junk loans. And so it was just this big cycle of selling crap to people and then selling that crap to an investor at a premium. Well, when this house of cards came crumbling down, people couldn't make their mortgage payments anymore, and then they started defaulting on their homes, and then home prices fell, and now these loans that banks were making, which were underlying these CDO investments, became worthless. And that meant that the CDOs, which were a package full of these worthless loans, were also worthless too. So banks lost twice, if not multiple times, on each deal. First, they lost on the lending side because so many people were foreclosing on their homes. And second, they lost on the investment side because now banks had hundreds of billions of dollars worth of CDOs on their books. So this triggered a whole financial meltdown because banks couldn't recover from this loss of making all these horrible and risky investments. And that's when the government and the Federal Reserve came in and they bailed out the banks with taxpayer dollars, and they slapped the banks on the wrist and they said, don't do that again, please. So let's look at what banks did and people did after this 2008 financial meltdown. And I'm going to talk about that in just a second, but I really want to emphasize that this is why financial education is so important. That way you understand how to take care of your money and you understand how to use your money. That way you don't have to rely on your bank, the government, or your employer to tell you how to use your money, because you need to be the one that's money smart. Plus, chances are that your bank doesn't have your best interest in mind. That's what financial education is all about. Having the right education, that way you know how to use your money the right way to build your own wealth. And if you're looking for an easy way to up your financial education, well, we have a free ebook on money management and investing that you can read for free when you sign up for our financial education emails, which are also free. You can get our ebook and start getting your emails by clicking the link up here or by clicking the link in the description below. And in case you were wondering, our financial education emails are different from our financial news emails. After the 2008 crash, we learned that the real estate market kind of lags behind the stock market by a couple years. When the 2008 crash happened, the stock market tanked in 2008 and then it bottomed out in 2009 before it started to recover. The real estate market, on the other hand, didn't really start crashing until after 2009, and then the real estate market hit its bottom in 2012 before it really started to recover, and by 2012, the stock market had already recovered quite a bit. You can buy and sell a stock in literally a matter of seconds, which is why prices on the stock market can fluctuate so much and so fast. Real estate doesn't work like that. Buying or selling a property can take you months, if not a year. And so real estate prices move a whole lot slower, which is why you see the lag time behind the stock market. And that's especially true for economic slowdowns, because during economic slowdowns, people get scared in the stock market and they start selling immediately, which makes the price tank. But in real estate, the slowdown needs to develop, and this needs to develop into a smaller demand for real estate, and slowly you'll see the price of real estate fall because of that. Right now, you have three factors coming together that could could trigger a real estate crash, so you need to pay close attention to these three factors. 1. Landlord delinquencies. 2. Consumer foreclosures. And 3. Shrinking demand. Let's start with landlord delinquencies. Between March and April 2020, more than 10 million Americans lost their jobs. Now, a good chunk of this 10 million people will get their job back when this pandemic ends, but not everybody will. This sudden spike in unemployment means that lots of people won't be able to make their rent payments. I mean, in the first week of April, nearly 1 in 3 tenants didn't make their rent payment. This is an issue that every real estate investor, including me, is facing right now. So I told my property managers that if one of our tenants faces a hardship and they can't make their rent, give them a free month of rent. Just let it go. But I know other landlords that disagree with me, and so they're adding up missed rent, late payments, and everything else. That way, once this is all done, they're gonna file a bunch of evictions, and then they're gonna sue these tenants, and they're gonna spend a lot of money doing that. But if these tenants don't have any money, you spent a lot of money suing them trying to win this lawsuit, but they have no money to pay you. So chances are you're gonna see a lot of evictions over the next 6 to 8 months, and if the economy stays slow, that means it will be hard to find new tenants or qualified tenants to take their spot. Now, couple this economic crisis with the fact that many landlords follow the zero down model, which means load up on as much debt as possible so you have zero margin for error. And now you just created the recipe for landlord delinquencies and foreclosures. Real estate investing is great, but you want to be able to afford your investments too. The more debt you take on, the more headache you have to face. And if you really want it to be a passive investment, you want less debt. I know this is not what people want to hear because they don't want to hear that they can't afford something, but I'm not here to tell you things to get you to like me. I'm here to tell you things so you're financially educated. The second issue is consumer foreclosures. Around 2017 or so, mortgage lending practices really started to loosen up again. In 2017, Fannie Mae released a program to help people with too many student loans apply and get qualified for a mortgage, because if you have too much debt as it is, the simple solution is just give you easier access to more debt. Duh. What this program essentially said was if you can't qualify for a mortgage because you have too many student loans, then there are practices that banks can take legally to essentially ignore the amount of student loans that you have. That way you can get qualified for a mortgage. My bank loves me. Then in 2018, we saw subprime mortgages come back to life for the first time since the 2008 crash, this time with a new name called non-prime mortgages because, you know, this new name is more friendly than subprime mortgages. By the way, a subprime mortgage or a non-prime mortgage is when a bank loans you money to buy a home even though you're not qualified to buy a home, and in exchange you get to pay me, the bank, higher interest. Again, what these programs do is they make it easier for you to follow the American dream and buy your dream home. And what that translates to is it makes it easier for banks to make risky loans to people who can't afford them. Oops, did I just say that on YouTube? And then in 2019, when our economy was supposedly booming, the Federal Reserve Bank came out and they cut interest rates again and again and again, which is something you don't do usually unless you are in a recession. This cutting of interest rates makes getting a mortgage more accessible while banks were loosening their lending standards. Clearly, lending practices became bad over the last few years, but they didn't become as bad as they were before the 2008 crash, so maybe this pandemic stopped lending practices from getting much worse. However, there's still a good chunk of people out there living in homes they can't afford, and I'll couple that with a pandemic that we've never seen before, so there's still a lot of uncertainty as to what's going to happen next. Just look at the numbers. 64% of American adults are homeowners. Yet almost 7 out of 10 American adults don't have $1,000 saved up to protect them from an emergency. And right now, 10 out of 10 Americans are in an emergency. So if the economy stays slow, you have a big chunk of people who will immediately get behind on their mortgage payments that they won't be able to recover on. So you could see an uptick in foreclosures. And if things don't pick up quickly in the economy, you're going to see more and more people get behind on their mortgages, which would bring the price of real estate down. Now, finally, let's talk about the third factor that you need to pay attention to: shrinking demand. Remember, the price of real estate is determined by supply and demand. When you have more buyers than sellers, then the price of real estate will generally go up. If you have more sellers than buyers, the price of real estate will generally go down. For the last number of years, real estate has been in a seller's market, which is when you have more buyers than sellers. So sellers are happy because they get to usually get the top end of their asking price. And now, because banks have been bleeding money and are in pain because of their bad loans and risky loans that they've been making over the last few years, they're having to tighten their lending requirements, kind of like we saw happen after the 2008 crash. So JP Morgan Chase Bank, who is the largest lender in America, came out and they just said that if you want to qualify for a mortgage through them, you need to have one, a 700 FICO or credit score minimum, and second, you need to have a very minimum of a 20% down payment, otherwise you can't get a mortgage. That means now a lot of people won't be able to qualify for a mortgage and they won't be able to buy a home, which means the demand for homes will come down. But that's not all. When people are worried about a recession, or they're worried that they might lose their job, or they just lost their job, or they're worried about getting sick, then all of a sudden the demand for real estate drops and now you have more sellers than buyers. Now, there's a chance that when this pandemic is over and when these lockdowns end, people will go back to living their lives, the economy will open up, and it will be like nothing ever happened. If that's the case, then real estate prices might not get hurt that much. But there's also a chance that when this pandemic ends, people will still be scared to go out and spend their money, which would probably put us into a deeper recession, and that could make real estate prices really get hurt over the next couple of years. Like, if the economy stays slow and you see an uptick of foreclosures, and at the same time people put off their dreams of buying their home for a few years, now all of a sudden you're going to see a shrinking demand to buy a home, and you're going to see an increase of supply of properties, which would make the prices of real estate come down. So there's a lot of uncertainty relying on how long the economy is going to stay slow. The longer it takes our economy to recover and get back into full swing, the harder the real estate market is going to get hit. But again, this isn't something that you're going to see overnight. This is something that will take 12 to 18 months before you really start to see the effects of it. And again, this is why financial education is so important. And if you want to up your financial education, we have a free ebook and financial education emails in the description below. Thank you for watching. If you enjoyed this video, share it with one friend, that way we can help spread the word. If you want to learn more about real estate investing itself and things you should know as a real estate investor, I already made a video on it, and you can watch this video on YouTube by clicking this button right over here. Thank you for watching, and as always, keep hustling.